This is the history of the exchange rate in Australia back to 1969, and you can see that our currency was disappearing downwards all the way through to around about the turn of the century, and it's been climbing ever since. But I think if that trend tunnel's right, it may well be that we could drift down for 2 or 3 years and then start to climb again. Why would we start to climb? And I think it's because with the quantitative easing that America's pumped in, which has been trillions of dollars, would have been, there'll be so much money sloshing around that you've got a runaway inflation problem on your hands, and that could weaken their currency, and we could go back to $1.10 or even $1.15.
We have seen it during the course of this last 6 months depreciate certainly well over 10%, and certainly the predictions are that it's going to sort of maybe head down to the early 80s. Whilst that's probably good for a number of industries, it's also going to certainly have an impact on others.
But in the case of businesses, there are of course winners and losers, and when we saw the Australian dollar go to $1.10 US, that in a sense was great news for retailers because they could import a lot of goods much more cheaply than they'd been doing, and therefore get those tills turning over at a much faster rate. But it was not good news for manufacturing because they were finding it very difficult to export, and it was much easier for their own products to be displaced by cheap imports. Tourism was very, very hard hit because we now have far more tourists going out than coming into Australia.
So those industries, if they haven't started to look at their business plans and assess the impact of a further fall in the exchange rate, ought to be.
So some win, some lose when the dollar is high or when the dollar is low. But generally for the economy, it all sort of averages out at the end of the day. And the exchange rate has a buffering effect on the economy. Interest rates do the same thing, of course. If you're an investor, you want the interest rate to be as high as you can. So when interest rates go down, it's not so good for people who are savers and people who are investors, like superannuation. Because if you're a borrower, then it's not so good. If your interest rates are high, you'd really rather them to be lower. So there again, there are winners and losers depending on these things. They don't necessarily, on their own, mandate a boom in insolvencies just because the exchange rates change or the interest rates change. They may affect particular industries, but they don't really mandate a rush across the economy.